welcome and joining us today. I'm Sue Crockett, the Executive Director of the Minnesota Center for Employee Ownership, and we will be presenting with Deb Linder from Frederickson and Byron Law Firm, Neil Brosen from Ventura Esop Fiduciary Services, and Doug Harmon, owner of Twin City Die Castings Company. So by way of introduction of them and CEO, we're talking about the silver tsunami. You can go to the next slide. And we all know it was coming, but it's here. And we'll go on to the next slide and kind of click through these quickly. There are 52,000 business owners in the state of Minnesota that are over the age of 55. So I think across the state, we all know that there's a crisis looming and what will happen when these businesses decide to transition out. 60% do not have a plan. 30% of the small business owners will never find a buyer. And with no buyer in place, 500,000 Minnesota workers are at risk with a $19 billion in annual payroll. So we at the Minnesota Center, we can go to the next slide. We are a 501c3 nonprofit, and we serve solely as a free, unbiased hub of education and resources on all forms of employee ownership. We want to empower business owners and their advisors to understand the different options of employee ownership so they can make the best choice for themselves and to create wealth equity and a financial future for workers who may never have had that. Next slide. So the Minnesota Center is part of the Employee Ownership Expansion Network. And Minnesota was the second state to open a state center. And as you can see, the growth across the country has been successful, meaning that this is really the time, and everybody knows that there's a need for education around exit options. Next screen. So on our website, we have an interactive map, and I think this is really a powerful tool in that it shows the number of businesses in Minnesota over the age of 55. And the circle shows the industries that are affected by that. And the next slide, I've highlighted Olmsted County. When you go to the interactive map, you click on the county and it'll show the number of businesses in that county. So there's 592 in Olmsted County. And I'm going to put the link to this map in the chat room because I think it's really important to go into the area that you're in and see the impact of the retirement. Next slide. So what is the answer? And we can keep going. So the most important thing is for a business owner to have a plan. And that means starting, even if you're not 55, but being ready for and knowing what you want for the future. What do you want in transitioning your business? Do you want to leave a legacy? Do you want to reward your employees? And do you want to keep the business in the community? Once you know these things, you can have a plan. So like I said, we talk about employee ownership of all forms at MNCEO. We're going to talk today about an ESOP, but we also talk about worker cooperatives, which are good for a smaller company, and employee ownership trusts, which is fairly new to the Midwest. They actually started in the UK, and they are on the East Coast and the West Coast. And we are working now on a couple of companies in Minnesota. And once we have that, it'll be really exciting to say, here's a new option for employee ownership. So EOTs are more flexible than an ESOP. However, they're not a retirement plan like an ESOP, and they don't have the tax benefits of an ESOP. So these are the three other forms of employee ownership that I would be happy to talk to anyone about, and we can go to a little bit more depth on that anytime you would like. The next slide shows what is a cooperative. I noticed that there's some smaller companies on the telecast today. So I wanted to go over what a cooperative is. And it's not the cooperative like the grocery store that's community-based. It's more the employees while they're in the business. And it is owned and democratically controlled by the people who use it. So they make their money while they're working in the cooperative. And again, it's a good way for an owner to get fair market value, for the employees to gain some financial wealth, and for the jobs to stay in the community. So we've talked a lot right now about retirement, but there are other reasons that people exit their businesses. And today we're going to talk about one of the 5 Ds, and that's death. Doug Harmon, the owner of Twin City Die Company, has owned the company with his brother, and the brother died. And so Doug had to decide, okay, what are my next steps? What am I going to do with the business? So let's get started with talking about, first of all, ESOPs. And I want to introduce you to Deb Linder with Frederickson and Byron, and she's going to kind of go over the basics of it. And then we'll move into Neil, who will talk about the trustee aspect of an ESOP. And then Doug will tell his company story. And so stay tuned, because it's really a great story of how he made that transition. So Deb, I'll let you take over.
Thank you, Sue. And thank you for the opportunity to speak with you today. We're going to talk about ESOPs, as Sue mentioned, and just to give you a little overview of what an ESOP is and how it operates. So who is the typical ESOP candidate? The typical ESOP candidate is either a C or an S corporation. You should know that LLCs and partnerships cannot sponsor an ESOP. It must be a corporation. And typically it's going to be a mature company. A company that has a strong and stable payroll base and employee population. Normally you would have an owner or maybe several owners who are at or nearing their retirement age. And they also need to be willing to embrace an employee ownership culture, meaning that they are willing to share at least certain financial information, certain strategic goals, certain information about the company that maybe they haven't had the opportunity or the need to share in the past. And all of that will help develop the employee ownership culture. And then typically you would have a successor management team in place so that they are in place, ready to take over the running of the business as the owners gradually exit from the company. Next slide. So what is an ESOP? Well, an ESOP really is just another form of a qualified defined contribution plan. You folks may be familiar with a 401k plan or a profit sharing plan where employees have an account that has cash contributed to it, and that cash then is invested in mutual funds and other investments. Here, an ESOP is a defined contribution plan, but it's designed to primarily invest in employer securities, meaning company stock. And just like any other 401k profit sharing plan, there are going to be a number of requirements under the Internal Revenue Code and from the Department of Labor under ERISA. Many of the same rules that apply to a 401k plan also apply to an ESOP. And then there are some special rules that are unique to ESOPs. For example, there are special rules relating to when participants have the right to vote the shares that are held in their accounts. When do they have the right to demand a distribution in the form of shares? And if they do receive a distribution in the form of shares, what sort of put options, meaning can they force the company to repurchase those shares from them? And then, of course, as the participants reach their retirement age, they most likely would have an opportunity to diversify their account by taking a portion of their shares and converting it to cash and investing it in other investment vehicles. So those are some special rules that relate only to ESOPs that you wouldn't find in a regular defined contribution retirement plan. Next slide. What are some of the benefits of an ESOP? Well, as Doug will more than likely share with you, as time goes on and the employees understand and value the ESOP culture, it has a tendency to improve motivation and productivity. Employees will now think of themselves as owners. And what can they do to improve the bottom line, make the company more successful, and so forth. It also provides a market for the selling shareholders. Maybe, like in Doug's case, the owners aren't ready to sell all of their shares to the ESOP. They may sell only a portion of the shares. And then as time goes on, they may want to sell more, in which case now the ESOP provides that ready market for the selling shareholders. And as we'll see in a minute, it can also provide a tax-favored source of capital for acquisitions, debt refinancing, and other capital types of activities, a very tax-favored source of financing for those activities. There are some tax advantages with an ESOP. Of course, for the participants themselves, it's just like in a 401k plan. The money that's contributed to their account, the shares that are allocated to their account, the value will, as that grows over time, that is not taxed to the participants. They are not taxed until they ultimately receive the value of their account. For the selling shareholders, if it's a C corporation, there is an opportunity for the selling shareholders to defer the gain on the sale by doing what's called a 1042 rollover. If the selling shareholders sell at least 30% of their shares to the ESOP, they can take the proceeds of the sale, reinvest those proceeds, and defer the gain on the sale. At the moment, that option is only available to C corporations. It is not available to S corporations, but there is some movement in Congress to expand that 1042 rollover opportunity to S corporations as well. So we'll have to keep our eye on that. But at the moment, it's C corporations selling shareholders of a C corporation that can elect the 1042 rollover treatment. For S corporations, if you're familiar with S corporations, you know that the net income of the corporation is allocated out to the owners of the business each year. Well, an ESOP is held, the assets of the ESOP are held in a tax-exempt trust, just like in a 401k plan. The portion of the income that's allocated to the ESOP is not taxed because it is a tax-exempt trust. It doesn't pay income taxes. So that portion of the income will not be taxed, by either the ESOP or at the corporate level. That's why many companies, their goal is to get to a 100% S corporation ESOP, because then the net income of the corporation will not be taxed at all under today's tax rules. I don't know that I would call it drawbacks necessarily, but I would say that there are some things that you need to bear in mind as you're thinking about setting up an ESOP. ESOPs are heavily regulated, and you will need experienced advisors, attorneys, accountants, record keepers, trustees, valuation experts to help you with the design and the drafting of the documents and the administration of the plan. There are some unique nuances to an ESOP that you may not find with a 401k or a profit sharing plan. And so you'll need experienced advisors to help you navigate all of that. ESOPs are also subject to IRS and Department of Labor scrutiny, and I will tell you that the Department of Labor in particular is very active right now in terms of auditing ESOPs. So it's just something to bear in mind as you think about this alternative. Going forward, once the transaction is set up, well, first of all, let's talk about the transaction. There are some costs involved with doing the ESOP transaction. To set up the plan is probably going to be a little bit more expensive than you would find with a 401k or a profit sharing plan. Because when you do the ESOP transaction, you'll need to hire an independent trustee that, like Neil, that trustee will have their own valuation expert and their own legal counsel. The company will have its legal counsel. Sometimes the selling shareholders will have their legal counsel or business advisors involved. So the cost can be fairly significant when when you're doing the ESOP and trying to negotiate the terms of the transaction. Going forward, there will be an annual appraisal of shares that needs to take place. You will likely have trustee fees if you keep the independent trustee in place. Otherwise, it's the same kind of annual filings like a Form 5500, record keeping expenses, and so forth. Those expenses come along with any qualified retirement plan. So you'll have those expenses as well, in addition to perhaps the trustee and appraisal fees. As you look at the ESOP, you'll also want to consider the cash flow needs. If there's a loan involved with the ESOP, then the ESOP is going to need to have cash to repay that loan. And that cash comes from contributions made by the company. So the company will need to be thoughtful about what it can afford in terms of a contribution to the ESOP each year. That consideration will usually drive the length of the loan and how the transaction is structured. In addition to that, the ESOP needs cash in order to fund distributions to participants who terminate or retire, or as participants near retirement age, their diversification elections. The ESOP will need to have cash for those distributions as well. So you'll hear folks talk about a repurchase obligation study, which is just, I guess, a fancy word for saying we need to project out the cash flow needs for the ESOP and how will the company finance that or contribute, or how will it get cash into the ESOP to satisfy those requirements. Also bear in mind that there are some allocation restrictions that come along with ESOPs. In the C corporation setting, if the selling shareholders do a 1042 rollover, then neither the selling shareholders nor their family members can receive an allocation of those shares back inside the ESOP. They are prohibited from essentially participating in that aspect of the ESOP. And for S corporations, the IRS has developed some rather complex testing rules that apply each year that are by and large designed to make sure that the allocation of the shares is broadly throughout the employee base, not just concentrated in the hands of a few. Yes, next slide. As with any qualified retirement plan, there are fiduciary liabilities that you need to consider. As with any retirement plan, there's the duty of loyalty, meaning that the fiduciaries of the ESOP, which can include the trustee, board members, committee members, whoever is involved with the management of the plan and the plan assets, they have a duty of loyalty to the participants to make certain that they are putting the participants' best interests first. They have to abide by the exclusive purpose rule, meaning that they are taking action exclusively for the purpose of providing retirement benefits for the participants and their beneficiaries. The prudent person rule applies with respect to the investments held by the ESOP. Here, there is no presumption of prudence, meaning that the decision to invest participants' retirement assets in the form of employer stock, that needs to be a prudent decision. The decision to hang on to the stock, to keep the stock in the accounts, that also needs to be a prudent decision. And then, like any other qualified defined contribution plan, the other investments held by the ESOP also have to be invested in a prudent manner. The fiduciaries need to avoid conflicts of interest. Many times you'll find that the same folks are serving on the board, they're officers of the company, and they're participants in the ESOP. They're wearing a number of hats. So there could be times where they have a conflict of interest. In those situations, we normally would see external board members appointed to the board of directors, having an external trustee, having some folks that are not associated or independent from the company, perhaps making the decisions. That's a way to handle and address the potential conflicts of interest that those folks have. The duty to monitor, of course, with respect to the trustee and other advisors, making sure that they're doing their job. Finally, with most retirement plans, there is a diversification requirement, meaning that the assets of the plan need to be invested in a way to minimize losses. Here, because the ESOP is designed to invest primarily in employer securities, there is no diversification requirement with respect to the ESOP. Okay, next slide. So let's just take a quick look at what a typical transaction would look like. So the selling shareholders now have decided that they want to sell all or perhaps a part of their shares to the ESOP. The way the transactions are structured, many transactions are structured today, is through a redemption plus a sale to the ESOP. So the first step would be that the company would go to its lender. Maybe it has a line of credit, maybe it needs to take out a loan, but it would need some kind of financing to redeem the shares from the selling shareholders. At the same time, the company will sell to the ESOP newly issued shares, and the ESOP will pay for those shares through a note, through a loan between the company and the ESOP. Now, the terms of all of those pieces of the transaction are going to be heavily negotiated between the company, the external trustee, and the selling shareholders. The price that the selling shareholders receive, the price for their shares, and the price that the ESOP pays for its shares is going to be subject to a fair amount of negotiation. All right, once we get through the transaction, we have the ESOP set up, and now the ESOP is going to repay that loan over time. The ESOP repays that loan with tax-deductible contributions from the company. So the company will make tax-deductible contributions to the ESOP, At that time, some of the shares will be released from the loan and allocated out to the employees. The ESOP will turn around and send the cash back to the company, which the company can now use to pay its bank or other financial institution. So the company has financed the transaction with tax-deductible contributions to the ESOP. That's why a moment ago we talked about the tax advantages for an ESOP and how it can be a tax-favored financing tool for other corporate events like acquisitions and debt refinancing. And that's my overview with an ESOP. With that, I will turn it over to back to Sue to introduce Neil, and we'll keep the seminar going.
Yes, and thank you, Deb. And if you have questions for the speakers, just pop them into the chat room and we'll address them at the end of the presentations, because we would like to engage you in a discussion about these options. So now let me introduce you to Neil Brosen, who's the co-founder and president of Ventura Fiduciary Services, who will talk about the role of the trustee. Go ahead.
Great, thank you, Sue. One of the things that Sue didn't say about my background that I'd like to add is that I've been on the board of the Employee Ownership Expansion Network for about 2.5 years. And the Employee Ownership Expansion Network is responsible for helping to create and fund the state centers. And the reason that the EOX exists is because we all believe that there should be 2 to 3 times the number of ESOP employee-owned companies than truly exist today, which is under 7,000. And we believe that the major problem is that business owners and their advisors don't have the information to understand what the ESOP option means. Now, while I certainly think everyone should sell to an ESOP, obviously that's not going to fit. But I think if people truly understand how it works and the benefits, that a lot more people would consider selling their companies to an ESOP to the employees than do today. I also want to comment on, make a comment on something that Deb said, that yes, the cost of an ESOP transactions can be fairly significant, but as Doug will mention later, they are still less and lower than the cost of selling to a third party. Next slide, please. So in my brief presentation, I'm going to cover these 5 points. One is the key elements of selling the company to the ESOP, the actual process and timeline. What I have seen in my 17 years of doing this work is deal hurdles, a little bit about financing options, and the last point are closing considerations. So when you look at the key elements of an ESOP purchase, number one, you need to begin with a willing buyer and a willing seller. And this is really important because, as the trustee gets hired, the Department of Labor has this belief that the trustee is hired because the trustee has already agreed to the price and terms, which is absolutely not true. And that's why we want to kind of emphasize the willing buyer and seller. Transaction is fully negotiated. This is a critical element in documenting the negotiation process. And as you'll see in the timeline, it does take at least 2 weeks and longer sometimes. And it's really a give and take where the term sheet is passed back and forth, and each turn of that term sheet will agree to maybe 1 or 2 more elements, but it does take time. Deb mentioned that both the seller and the buyers have their advisors. The deal structure is put together by the seller's advisors. As the trustee, we're not structuring the transaction. We're going with, for example, let's say if Deb is representing the seller and they've also got a financial advisor, that they will put the structure together. With regard to the financing, again, most ESOP transactions are financed probably 50% by a bank, and the balance of the financing comes from the sellers. Now, we will negotiate the terms of the seller financing. The bank financing absolutely is the best financing that the company can obtain, and the trustee is not involved with that. Secondly, I would say that the board composition after the transaction is a key element to what we negotiate. Most private companies, the board might compose of the sole shareholder and maybe that person's spouse, And what we need to do is end up having the board that has a representative of an independent director. And if the total board count is 3, I will negotiate to ultimately have 1 independent director. And by independent director, we mean someone who's not a relative, not an employee, has not done substantial work for the company or the seller. Deb mentioned the tax benefits. She also touched upon the Department of Labor issues. And the third element of this transaction is, the employees are not involved in the negotiation. Neither is the management team. The trustee is acting on behalf of those future employee owners. Next slide, please. The transaction process, as you can see from my example, I show this in a 12-week period, but as I note at the bottom, most of the transactions take between 60 to 90 days. The elements, what you see here, are going to be the same, whether it takes 60 days, 90, or 120 days. And what's really important, I think, is what typically takes the most time is getting the bank financing in place. So we like to start a transaction with the bank financing either in place or that the advisors or the company have already contacted a number of banks and have begun that discussion. Because if you don't do that in the front end, it'll make the transaction timeline longer. The process actually begins with a kickoff meeting, an initial due diligence meeting, where the trustee team, the sellers, key representatives of the management team, and the seller's advisors get together for perhaps 3 to 4 hours. And we want to come away from that meeting with a very good understanding of the business, where it came from, where it is today, and more importantly, where is it going? And that's just the beginning of the due diligence process. As you can see from my 4 diagram, the due diligence process will continue beyond that initial kickoff meeting. The next event that happens, and this is a little unusual compared to non-ESOP transactions, is that the seller typically presents the proposal. They present their term sheet, including everything that they want, whether it obviously includes a sale price. It may include the terms of the seller financing, board composition, and other things with regard to reps and warranties. But the trustee is not going to respond to that until we've already got the draft valuation report from the financial advisor evaluation firm that we've engaged. And it's important to note that it's a draft report because it will not be finalized until the transaction is almost complete. Now, for me, I operate as an individual trustee, and so I take that draft valuation report and we present it to my advisory board. Other trustees, individual trustees may or may not have that process, and institutional trustees, such as banks or trust companies, they will have a committee that will review everything. Now, when we're completed with that advisory board meeting, we will then respond to that initial offer. And again, we'll either mark it up the actual term sheet or we'll put it in an Excel spreadsheet and just go back and forth with that. And as I said, the negotiation process could take, several weeks. Ironically, if the seller offered a great term sheet that was absolutely acceptable to the valuation firm in terms of the price at below the low end of the range that they provided in their report, and all the other terms were acceptable, the Department of Labor probably would not want me to accept that because they expect some negotiation, which is a bit different. Once we then negotiate the timesheet and we get that completed, that probably will cover, I'd say, 80% of the elements that will be in the actual transaction documents. And so the next step is to let those transaction documents be drafted, negotiated, and ultimately we'll get to the closing. And most of these closings are done electronic signatures, they're anticlimactic. We're all just kind of happy that we completed the transaction at that point. Next slide, please. Thank you. Again, when I look back at what has created challenges, I use the polite term hurdles, there's a pattern to what I've seen happen that makes transactions difficult. And the first one is really the most important one. If the seller has an unreal expectation of what they think the company is worth, we may never be able to get an agreement if it's unreal. Now, when you have the seller that has advisors and they can give the seller a pretty good estimate of the value, and they use a similar methodology to what my evaluation firm will use. Yeah, the negotiation will be that they'll certainly start high and then come down in the negotiation process, the same way I'm going to start low on my counter, but we'll be able to, there's no hurdle to overcome in that. Certainly, sometimes we see projections that were given, and they're given to us by the company. We don't prepare them ourselves, which again is a little different than third-party transactions. And all of a sudden, you're seeing the growth in revenue at a rate that is so disconnected to what they've accomplished in the prior 5 years. That's a bit of a challenge. I've also seen situations where the advisors that the seller has don't have a lot of Esop transaction experience. And these really are unique transactions. And so that's a challenge. And I list a few other items that, we get everything negotiated, the term sheet signed, we haven't closed. It could be a month or two before closing, depending on the situation. But if there's something, that event that occurs before closing, we can't just ignore it and close. And such as you can see, these kind of things have happened. These are real issues where, a key client leaves, a key executive leaves, their financial results for the more current months than we had from the valuation report decline, regulatory issues, or new litigation. Now, that doesn't mean we don't close. It means we need to stop and assess the impact on the valuation and the terms that we agreed to. Yeah, and real quickly, and I apologize that the font's so small here, but again, if you look at the different types of financing, the company can borrow money. It's a lot easier if you have a manufacturing company that has collateral. We see banks will lend on a 2 to 3 times cash flow. Banks really like ESOP lending because the default rate on ESOP loans is so much lower than non-ESOP company loans. Again, you see the traditional senior lender. There, you can sometimes have a mezzanine lender that will come in. Almost every transaction has some kind of seller notes. And a lot of times those seller notes will come with the detachable warrants. And occasionally you'll see private equity fund provide some funding for an ESOP transaction as well. The last thing I want to cover in the next slide is that there are really 3 elements that I have to be able to meet, or the transaction has to meet, for me to be able to close the ESOP transaction. The first one is that the price that I pay on behalf of the trust cannot exceed fair market value. And I'm sure you're saying, well, yeah, but who determines that? Good question. The good news is that that fair market value is determined by my valuation firm. And in that draft report that I referred to earlier, that report contains a range of value. And let's arbitrarily pick numbers. Let's say 8 and 12 is the range of value. I cannot pay 12.1. I cannot pay $1 over that 12 because that exceeds fair market value. And on the other hand, at that low end, the seller doesn't probably want to sell. And it's not just about meeting in the middle, because I want to be able to consider all of the other factors we're negotiating and determining the price that I'm willing to pay. The second element is that in the financing, this is really referring to the seller financing. And as you can see, the terms, whether it's the length, whether it's the interest rate, whether it's the warrant returns, have to be commercially reasonable. And again, that determination is made by my valuation firm. And the third element is kind of a catch-all that says, from an overall financial perspective, the transaction has to be fair. Now, those 3 elements are what will be in the fairness opinion that the valuation firm will issue to me, saying that we've operated within those parameters. And the other thing that's not on here that's important to recognize is, getting to the closing is great, but we also want to make sure that the company will be sustainable going forward. So the valuation firm will do a lot of testing in terms of stress testing of the projections to make sure that the debt can be serviced. And with that, I will turn it over to Doug.
We'll let Doug get set up to move on with his slides. Doug Harmon is the chairman and owner of Twin City Die Casting, and we'll be sharing with you his story of transitioning to employee ownership.
Okay, thank you, Sue, and thank you, Deb and Neil, for your input and explanations on the ESOP. What I'd like to do now is share with the group, really the experience that I had going through my exit process and ending up in an ESOP. Just a little bit about the company, Twin City Die Castings Company. We were founded in 1919. We're the third oldest die casting company in North America. And we've had the majority owned by an ESOP since December 12th of 2017. So we're actually in our midway through the 5th year of our ESOP. We have 220 employees. Our annual sales revenue is $50 million. We have 3 plants. Our original plant and headquarters is in Minneapolis. We have another plant in Monticello, Minnesota, and a 3rd plant in Watertown, South Dakota. Just real quick, I just wanted to share some of our customers and market share. Passenger vehicles is the largest share for the die casting industry. About 68% of all die castings go into automobiles, engines, transmissions, structural components. And this is just a list of some of the tier 2 suppliers that we sell to. They take our castings, our customers take our castings, put them through an assembly manufacturing process, and then sell them to their final customers. Passenger vehicles are Twin Cities' biggest market. We're about 55% with passenger vehicles. We also sell into the commercial vehicle market. We also sell into power sports, the recreational area, ATVs, snowmobiles, motorcycles, wave runners. Medical, we have a number of medical accounts we sell into. They use these housings to produce their electronic parts that go into the hospitals. Defense, we have a small defense aerospace market that we sell into. And then a couple of the other markets would be HVAC. You'll see Emerson up there. And also we sell components that go into construction hand tools. Stanley Black & Decker happens to be an account there. This particular chart is a graph showing over the last 100 years, kind of some key milestones. I'm not going to go through all of them, but I would like to identify 3 of them. First being in 1919, Charlie Adams founded the company, and his family ran the business up through the early 70s. At that point, my dad, who was on the board of directors of the company, was offered the opportunity to buy Twin City Die Castings Company through a leveraged buyout. The sales of Twin City Die Casting at that time were around $4 million. A couple years after my father entered into the transaction, he brought on my two brothers and myself, and then we ran the business, really up through the 2000s. And the next event I want to kind of focus on is the 2005 event. That was a major event in Twin Cities history. And that was when my older brother, who was the president and CEO of the company for 22 years, was diagnosed with pancreatic cancer. And within 90 days, he passed away. Obviously the death had a big impact on the company and on myself. I was a 50% owner at that time with my brother, and decisions had to be made. So, after a lot of thought, I was 53 years old at the time. And after thought and consideration and discussion with my family, I decided that I would go ahead and step in as the CEO up until my retirement age. So that was what I did. And then about 10 to 11 years after running the company as the CEO, I was now 64 years old and knew that I wanted to develop an exit strategy. I wanted to have the exit in place by the time I was 66 or 67 years old. And so now I had to begin that process. So my exit process, the first steps was to establish a time frame. I had talked to our attorneys, to our accountants, and realized that really to set the company up for sale, it was going to be a 2 to 3 year process. So that was my time frame. Again, speaking to the attorneys and corporate accountants, listening to their advice and the options that were out there. met with an investment banker to learn about private equity. This was one of my options, you know, a third-party sale or looking at selling to the employees. So I met with a private equity firm to start gathering some information. And I decided there was a recommendation that I hire a business consultant who was involved with sales of preparing companies for sale. And so I hired this outside consultant to help me with preparing the company for the eventual sale 2 to 3 years down the road. So I took some informational meetings from the private equity groups. I dealt with 3 local, 1 national. And then I also started researching the ESOP concept for the employees. Set up meetings with ESOP experts who were recommended by our attorney, our accountant, and our banker. And then talked to 2 industry peers. One had set up an ESOP just the year before, and the other industry peer was in the process of setting up an ESOP. So what did I learn from the private equity group interviews and discussions? That it's a financial transaction for private equity groups, a lot of times third-party groups. They'll look at it in a 3 to 5 year cycle. They want to gain controlling interest to help restructure the business. They want the owner to stay involved for 3 years to achieve and meet certain metrics and goals they have established. If those metrics or goals aren't established, then there'd be a reduction in the selling price that the owner would receive. The fees for this type of transaction are 5 to 10% of the sale price. I'll share what the ESOP is here a little later on, but so there's some costs in going through a third-party private equity group. And then the other point is that it is a financial transaction. They want to take a business, try to restructure it, and set it up for an eventual sale, which is 3 to 5 years down the road, for the highest price they can get, and then that would reward their investors in the group. But it largely ignores the relationships that family businesses have developed with the employees, their customers, and suppliers. 2 flags that were raised after talking to these folks were that few of the firms really have the necessary expertise in dealing with capital-intensive industries. The die casting industry is very capital intensive. Our sales to produce castings range between $1 to $1.2 million for the complete sale with automation, furnaces, trim presses, etc. And the other red flag that came up is that I had known several of my peers who were family businesses involved in the industry, and they ended up selling to a third party or private equity group. And after a couple of years, those transactions just weren't successful. They struggled quite a bit and just didn't perform. So now the lessons learned from the ESOP. Employees are owners with a tangible interest in the company, and it doesn't cost them anything. We have S Corp status, and because of that, it removes the federal and state taxes. So that allows the business to take those savings and use to help pay down debt. The initial transaction can be any percentage. I sold 51% to the trust, but it can be any percentage to the trust. And then the employees now have an additional retirement benefit besides their 401k. Costs for an ESOP, in our case, ranged around 1%, and with the private equity groups, it was going to be in the 5 to 10% group. It's flexible and affordable way for ownership to transition the business. The ESOP benefit is a good benefit for attracting and retaining good employees. You know, it definitely has an impact and influence on our turnover. And then the other thing that was real interesting for me is that the selling price was very similar to a financial buyer. I was under kind of the misconception that financial buyers could get more money through their sale, but that was not the case with our business. I mean, the selling price to the ESOP was very similar to what the private equity groups were saying. Okay, characteristics of a successful ESOP is a relatively stable cash flow, an expertise in the management team, and then a workforce that's motivated by potential growth and value. Benefits to the owner. I can offer any portion of my stock to obtain liquidity at a fair market value. And again, my initial transaction was 51%. I'm planning to sell the balance of my stock over, probably in 2 tranches over the next 2 to 4 years. It allowed me to retire, but still be engaged in the business at a reduced level. So I am the chairman of the board and conduct the quarterly meetings, but again, I'm enjoying my retirement status too. And then the company's success increases the value of my outstanding stock. So as the company performs, the stock that I still have will also go up in value. So I made my decision, felt good about the ESOP transaction. I'd always wanted to sell to the employees, provided there wasn't a large discount for the transaction, and there wasn't. The transaction recognizes the efforts and contributions of the employees in the company's success, and the company's future success benefits the employees, not a third party. And this was the best way to keep the family culture and environment in place and keep the company moving forward for the next 100 years. The first 100 years, there were 2 families that really ran the business, the founder and then our family. It's nice to have the employees be the owners now going forward. Okay, so my next steps were to inform our legal counsel and then select an experienced ESOP attorney. And we used Deb Linder based on her experience and knowledge and reputation. Very pleased with using Deb. We informed our accountant of the pending transaction. We let our 2 banks, we deal with 2 banks, let both banks know that financing would be involved to buy this initial share, the initial stock. And then it was up to select an experienced and reputable trustee. And again, we chose Neil. With Neil's experience, expertise, and knowledge, we felt very good with Neil as our trustee. Okay, so my ESOP process was choosing the ESOP trustee, provide the information that the trustee requires. There's a lot of financial information and just other information that they review. At this point, I have review, resolve legal, regulatory, contractual, and environmental issues. This is actually something that should be done prior to going into your sale. Just make sure everything is in line. Now, what happened because we had some bank financing, we had to do some environmental impact studies, and there was a small environmental issue that was uncovered, but it was small. It didn't have a major impact. Maybe the delay was 2 or 3 weeks in regard to the transaction, and we just took care of it and went ahead and moved forward. There's the negotiation process, and then agreeing on the final price and conditions. All during this time, we're in discussion with our attorneys, accountant, and bankers. Then we get to finalizing and signing the documents. Our process took between 4 to 5 months from the start of the process to signing the documents. After the documents were signed, we informed the senior management team. And then we announced it to the employees. This was kind of a fun event. We announced it to the employees at the annual Christmas party. The employees knew I was 64, 65, well, actually at that point, 66 at that time. And they knew I was looking to retirement. They didn't know really what direction I was going to go. So when it was announced at the annual Christmas party, they were quite excited about becoming employee owners of the business. What the ESOP means to employee owners. Well, the family culture remains intact. Increased performance rewards the employees, and there's an increased need for consistent performance. And then we are accountable to a trustee, board of directors, and banks. It's no longer the family, but there is a governance structure that's set up. Impacts to the company value, explaining to the employees financial performance is the big driver, earnings drive the value. But market conditions can come into play. Also, the growth of the business and future prospects can also impact that company value. And then another important point to share with the employees is the comparison between an ESOP and a 401k. we have a 401k in place, and we do a matching contribution, a matching percentage to the employee's contribution. But we also kept the 401k in place and also implemented this ESOP. But over time, the ESOP will outperform the 401k by a factor of 3 to 7 times. So that was very interesting to the employees, and obviously excited about where they'll be at their retirement stage. Shared with them the corporate governance, you know, the ESOP trust, and then trustee and who works with the trustee, board of directors, management, employees. But it's a little bit different governance structure. And then what the trustee interaction is, you know, they evaluate the business throughout the year. They get the quarterly board reports, attend board meetings as a guest. They meet with the valuation firm when the annual valuation is done and go through that. And then they'll review that valuation report with the board. Okay, there were some trustee conditions that had to be met, and one of them was the corporate governance. There'd be 5 board members, the selling shareholder, myself, 2 internal directors, which happen to be the CEO and president, and then 2 independent outside directors. There was also a condition for 3-year employment agreements for the chairman, the CEO, and president. Also a requirement for a compensation committee. This committee was made up of the 2 outside independent directors and myself. And again, it's to make sure that the compensation is in line and is reasonable. And then formalized quarterly board meetings. You know, this was a big deal. We had, before being a family business, it was, the board was primarily the, you know, some family members, and we would meet once a year and maybe twice, but more likely just once a year, and go through the board requirements. But now with the formalized quarterly board meetings, we meet every quarter. They're formalized, and it's really been a nice addition, having 2 outside independent directors that can give us good counsel and advice. Okay, we set up a plan for our senior management team. It's a management incentive plan, and it's established for our senior management team, which is comprised of 9 members. It's based upon 15% of the outstanding stock, and it's known as a stock appreciation rights, or SARs. Each team member would receive a percentage of that 15% decided by the CEO. And there's 2 components to their incentive plan. One is retention units, 50%, and then the other is performance-based. So it's set up in a 3-year block, and based upon how the company has performed, how the share value has increased from the first year to the 3rd year would indicate what the payout is for this management team. And 100% vesting occurs at the end of that 3-year period. Payout occurs at that point in time, and again, is based upon the stock value from the initial date of issue or grant to the current stock value. The Esop culture. At TCDC, we're on a mission to bring out the best in our employee owners in our work, in our homes, and in the communities in which we live and work. We will do this by organizing projects, events, and educational opportunities that help foster a culture of employee ownership. And again, we have in place an ESOP committee that's very actively involved with the employees. They put together barbecues and luncheons and giveaways, and it's just very active. We'll do community projects for different organizations like the Salvation Army. So it's very actively involved and really keeps the employees engaged in as employee owners, and just the family type culture that we've had over time. How can employee owners impact share value? They can be efficient in their job, follow proper work instructions, work safely, live the TCDC values, and control costs in their area. That's primarily what the hourly employees can do. The salary employees can then maintain the equipment, so there's no surprise downtime, improve processes, use capital wisely, negotiate pricing, collect our receivables, and then think like an owner, help our coworkers succeed and avoid unnecessary problems and distractions. So my last point is just how has the TCDC ESOP performed? Again, this is something once a year one of the activities or events for the employees is to get them together for a nice lunch and share with them what the value of the ESOP has done over the previous year. We did this in February, just 2 months ago, and here are the results. In 2021, our share value went from $27.95 up to $42.09. So it was over a 50% increase in share value. We go to the previous year, 2019 to 2020, it went from $16.99 a share to $27.95 a share. So that was also better than a 50% increase. And then you go back to 2018, that was the share value after 1 year of the ESOP. So you can see that the employees are getting engaged, they are making an impact, and the share value, has shown a nice gain and increase. So with that, I want to thank everybody for joining, and I'll pass this on.
Back to me.
Sue.
Back to me. Yeah, thank you, Doug. And look at that increase, and that was all during COVID, so the pandemic. So congratulations and good for you. We're getting close to our time. I know we have a couple questions, but I just wanted to wrap up and say that, Doug, I think the most important piece that you talked about was that you clearly looked at all your options, and you knew when you made the decision that it was the right decision for you. And I think that's what we want all business owners to do, is to make those comparisons, look at the pros and cons of each one, and not have any seller's regrets. So thank you for sharing your story. It's a great one. This one is just a slide about how you can help, kind of share information about employee ownership with people so that they can come to MNCEO. We have lots of resources on our website, mnceo.org. And we just help direct people. That's all we do, is get you to the right professionals, like Deb and Neil, that have experience in these areas and help you on your journey. So the last slide we have is one of our contact information. And then there's a couple of questions in the chat room. Doug, if you'll just go to that last slide, please. Okay. There you go. Okay. And then, so there's a couple of questions. One is from S. Campbell. Did the ESOP transaction include the real estate or business only?
The transaction that made included the whole business, the real estate and the business. Yes.
Yeah, and I think the question he's getting to is the answer is the company already owned the real estate. The real estate was not owned by the shareholders.
Okay.
And again, we do have transactions where that you have a related party transaction where the sellers hold on to the real estate and the ESOP and the company leases the property from the former owners. And as long as it's at fair market value, we're happy to continue that way.
Great. So another question comes from Michael Darger, and he's one of my colleagues at the University of Minnesota Extension. And he asked, is there any evidence of ESOPs being more likely to stay in their communities than when sold to financial buyers or private equity? I would say the answer is yes to that, but I'll let you all.
The answer is, oh my God, yes, it's a huge difference.
I would agree.
The reality is that's one of the reasons that some owners don't sell to third parties. And it's more typically strategic buyers too, where they don't necessarily need a facility. And typically you'll see in an ESOP transaction, very little changes. And I would agree with
that, Neil. I think in my experience, ESOP companies do stay in the community. They stay active and vibrant members of the community as a result of that transaction.
And more importantly, that a number of employees don't change. So for example, if you have a private equity buyer, if they pay a premium to buy the company, they're going to want it to be lean and mean. And how do you do that? You cut staff.
Right.
And you don't see that happening in ESOP transactions.
No, that's one of the benefits. The employee population really stays in place.
Yes, I would agree. So we are at our time here. We've covered a lot of information. And I know some people had some problems getting into the webinar. So I will send out a PDF of the presentation, and the recorded version will be on our YouTube channel. And once that's uploaded to that, I will send both out to the participants in today's session. So appreciate you being here. Feel free to reach out to any of us at any time. We're more than happy to talk about employee ownership and every option that there is available in order to close the wealth gap in Minnesota and in the United States. So again, thank you for joining.
Yeah, and like Sue said, you've got all of our email addresses. And on behalf of Deb and Doug, if you want to send us a question via email, we'll be happy to answer it.
Absolutely. Happy to do that.
Yeah.
Absolutely.
Okay, thank you and have a great day.
Thank you all. Have a good day.
Thank you all.